Welcome to Chapter 5, dear risen investment gurus. In this chapter, we're going to learn how to read financial statements and use their data to do ratio analysis. So whereas the tools that we learned in Chapter 4 were more of a yes, no, let's continue researching, or no, let's find some other option. This this research gives us a more rounded description of our potential investments and allows us to compare them to our competitors and to the industry as a whole and to the market as a whole. So I like to think of it like a stew. We're creating a stew, and no one piece of information is going to say yes, no, continue, don't continue. They're going to be like little flags that are planted, and we run from one to another to decide which ones are important and which we need to do more research with. Okay? So don't worry if you've taken accounting or if you're terrified of accounting. We simply use the financial statements that the accountants so happily give us. Thank you very much. Because, as we read at the bottom, if an accountant's spouse cannot sleep at night, all he or she has to say to their spouse is, "Dear, tell me about your day at work." I know we're going to insult everybody by the end of the semester, but accounting is difficult, folks. There's no sugarcoating. We're not going to do any trial balances. No no journal entries. So we allow the accountants to do their magic, and we use the fruits of their labors. Now, if you are interested in accounting, or if you're taking accounting, the more you know about accounting, the more the better you're going to be able to use this data, and I think the better it will be for you as an individual investor. So accounting is important, but I took accounting a long time ago, and after I left, I did well. I just said to myself, I ain't never doing that for a living unless somebody puts a whole big stack of $100 bills in front of me. Yeah, it's not an easy job, but it's an important job, and we investors are forever grateful for their work. So let's get started on slide number 2. Now, there are 3 financial statements that every publicly traded company must create. The balance sheet, we in the Principles of Money Management class know it as the net worth statement. That's the snapshot, the financial summary of the assets, liabilities, and what's left over. In the financial planning class, the Principles of Money Management, we call it net worth. The accountants call it equity, or shareholders or stock equity that's in the firm. The income statement is what we in the financial planning class called the cash flow statement. The accountants cringe when we do that. The income statement is the movie. This shows you the operating results, typically of a quarter or a year. What came in the door? Money came in the door. What did we sell? And then at the end, what did we earn? What expenses did we have to pay for those earnings? And what's left over is the net income. Now, the cash flow statement, or statement of cash flows, is something that we don't use in a financial planning class, because it turns out, and if you take an accounting, you're going to immediately know what I'm talking about, that some of the expenses that you report to the IRS to lower your taxable income, you didn't really pay those expenses. Nobody wrote out a check to those expenses. The poster child for this is depreciation. You don't write a check to depreciation, but it's an item that you put in your financial statements that allows you to lower your taxable income, which means you pay fewer taxes. But that money didn't leave the firm. So along with depreciation and many other entries, we have a statement of cash flows, or just called the cash flow statement. That shows you what happened to your checkbook. And that's an important document that publicly traded corporations need to produce. The more, let's read at the bottom. The more we know and understanding accounting, the better we will be able to understand and analyze the companies we are researching. And fortunately, we don't have to do any of the accounting because it's only gotten more and more and more complex. In so much so that I my eyes glaze over when the accountants, especially at the corporate level, say what they have to do to produce these things. I just think, oh my goodness, I don't even want to think about it. And again, as we said when we talked about dividends, this all could be malarkey. It could all be phony. And that's very rare, folks. It's not typical, but it happens. It does happen. And sometimes it's not even on purpose. And that's why sometimes it's just, oh my goodness, we really screwed up, didn't we? And that's why we always say dividends don't lie, because that's the one item that you know was true because they wrote you a check. Well, they don't write a check anymore anyway. So let's continue with the balance sheet. The balance sheet is the snapshot. It shows, whoops, excuse me, my mouse is very sensitive. The balance sheet shows us our assets minus our liabilities, and that's the ownership, the equity. Now, we tend to think of it as assets minus liability equals equity, but the accountants they switch the formula around a little bit. I don't know why, but they do. I think I know why. Assets equals liabilities plus equity. Why? Because they called it a balance sheet because they would take these huge sheets, they would spread them out that's where we get the term spreadsheet. They would tie all these, tape all these sheets together and spread them out on the tables. And all the assets would be on the left and the liabilities and the equity would be on the right. That's why it's assets equals liabilities and equity. And the two must balance. They must equal one another. Now, the accountants do something a little strange for us in the investment world. They lump all assets that are used within 1 year into current assets. Anything greater than a year is considered long-term assets. Now, for us in the investing world, in the personal finance world, long-term is usually 5 or 6 or 7 or more years. Intermediate term, 2, 3, 4 years or so. So just be careful about that. And we're going to use Sprouts Family Markets or Family Markets for our example. Okay, so just let's go on over and take a look at the Sprouts Family Market or Farmers Market. I can't remember. It's SFM is the symbol. So hang on a minute. Okay, I think I pressed the wrong button, but that's okay. Let's continue. Here in the on the class website and in Canvas, we have the three financial statements: balance sheet, income statement, and cash flow statement. So I'm going to use a separate window because it doesn't really show up correctly when I click on this. So I got a separate window going here. So I'm going to click on this now, and it's going to go. Well, actually, I'll show you what happens. Doesn't look that great. Let me show you over here. Okay, here it's better shot. We see the assets. Here's the Sprouts Farmers Market (SFM) balance sheet. And it shows us the current assets, and these are items that are going to be used within the next year. Cash, accounts receivable, what's that? That's money people owe you. Inventory, what are you have available to sell? And then any other current assets. And then the long-term assets, such as investments, plant, property, and equipment. Goodwill, what's that? It's sort of an accounting maneuver. The fact that the company is in business and worth something above and beyond what people think it would be worth if it were taken away. And then those are the total assets. Then we list the current liabilities, things that are going to have to be paid within the current year. And then so accounts payable, money we owe other people, short-term debt, long-term debt coming due, and other current liabilities. And then the long-term debt. Notice, actually we have to go back to 2017. what year is this here? This is it right here. 2000 from 2017 to 2018, right? No, 2018 to 2019. They loaded up on debt. Boy, oh boy, did they load up on debt, and that's because of the 2017 tax bill. Oh yeah, and interest rates, of course, were very low. So they took all that money and they turned around and paid themselves bonuses and bought more shares of stock and didn't really. The idea was to pay the workers more, and they didn't do it. So here is the total assets. Here are the total liabilities, and what's left over is the stockholders' equity. And it looks like Sprouts Family Market owns 1.148 billion. Oh, by the way, all of these numbers are times 100,000. So we're going to then learn later on. We're going to learn how to use ratios from these data, from these data points, to measure certain attributes about the company, and of course use that to look at other companies in the same business. So that was the balance sheet. Let's go back over here and let's see, make sure we don't mess things up. Here we are. So now the balance sheet. The income statement is the movie. That's showing us the money coming in, the revenues, and the money going out at expenses, including dividends and the like, and the net income, which is revenue minus expenses. Now, if you've taken accounting, you know that that net income is available to be paid to the shareholders in the form of dividends. Now, they don't have to, and it's very rare that they pay all the money out in dividends. And so what is left over is called retained earnings. That might ring a bell for some of you that have taken accounting. And don't have nightmares or anything. But as we said, okay, let's take a look at Sprouts's income statement. Come on, sweetheart. Here we go. Sprouts income statement. Let's see how it looks. Oh, good. It looks pretty good still. Here's the revenue. There's the top line number. Do you remember that from your listening and watching the earnings calls? The top line number, and then that's the money that came through the door, total revenue. And then the cost of that revenue. How much did we have to pay? Because obviously Sprouts is a grocery store. It doesn't grow the food or whatever. It has to buy that. They have to buy that. So that's the cost of the revenue. So there's their gross profit. And then they had to pay the salary and the lights and the rent and all the other things they have to pay. And those are operating expenses. Remember, sales, general, and operating, or sales, general, and administrative expenses. So their total operating expenses were over $2 billion. Notice they brought in almost $7 billion through their door. So their operating income was $350 million. But wait, there's more. Right? They have to pay interest. Notice that their interest payments are relatively low because they borrowed a ton of money at a very low rate, and they're sitting pretty and just going, ha ha. Now, I don't like debt, and I'm very adverse to my favorite motto in the Business 121 Principles of Money Management class is make love, not loans. But we're going to find that Sprouts has no trouble paying their debt, no problem. Then we got to pay income tax, and they paid almost $85 million in taxes last year to Uncle Sam and the other various states and local governments. And so then we get some things that usually aren't a problem, these non-recurring events, extraordinary items. So their net income, their bottom line was $259 million. So Sprouts is not one of the largest companies in the country or the world, but it's still a pretty big entity. You and I would love to make $259 million, huh? Yeah, right. So that's the income statement. And then, last but not least, is, as we said, some income and expenses are not always received or paid for in cash, and that's why there's the cash flow statement. Now, we're not going to get into details on the cash flow statement because it's pretty arcane, which is a fancy way of saying it gets pretty complex pretty quickly. But the one that is easiest to see is the depreciation. So let's take a look at that. let's go now to the income statement of cash flows, or the cash flow statement. And we see that it starts where the income statement ends. Remember, it was about $259 million. So it starts where the income statement ended, our net income. But then immediately, notice they put depreciation first. They add back in the depreciation. What happened for 2023, folks, is Sprouts was able to tell the IRS, hey, we actually have an expense of $265 million in depreciation. But they didn't write a check for that. They didn't write a check out to depreciation for $265 million. It's a non-cash entry. So it turns out that, yeah, they actually did have that money come through the door and didn't have to send it out the door. And then the others are basically the same. So what happens at the end of the cash flow statement, they bought some stock and the like. So you can learn more about that in an accounting class. We sort of just say, okay, assuming we trust Sprouts Farmers Market. It turns out that their checkbook went down $91 million last year. It went up $48 million the year before. So that's what the statement of cash flows, or the cash flow statement, tells us. It tells us, okay, yeah, you said you earned this much, but in reality, your checkbook went down $91 million. And that's fine, that's has really not to do with the actual earnings as applied by generally accepted accounting principles. Make sense? I hope so. I know it can, people's eyes glaze over, but don't worry about these. But they're important, especially when we get into companies that have record sales or record earnings, and their cash flow went down. Okay, their checkbook went down. Why is that? Well, we need to look into that, and we can see that in the case of Sprouts, they bought a bunch of stock back. So there was $200 million they bought in stock. So we would need to dig into those things if something looked a little funny. Like, wait a minute, you're reporting record earnings and your checkbook went down, or you're hurting for cash. Why is that? And we'll see some examples later on. Okay, cool. Okay, so let's get rid of that guy and let's continue. Where do we get this data? Well, it's generally available in many different places, but I'm getting more and more disillusioned with Yahoo and CNBC and MarketWatch. They do funny things with the statements. So I am now going to Edgar, which I forget what it stands for, but this is where the publicly traded companies must post their financial statements. And so when you did the earnings call, if you did it live, right before that earnings call started, the company, or maybe there's a I'm not privy to how they actually do it. They might have done it the week before and then they just set it to become live that day. They post those reports, including the cash flow statements, to Edgar, and then it goes live on a certain day, and that's when they do their earnings call. So I've been using that more and more simply because the others are getting a little strange. For example, MarketWatch is now rounding everything to $6.4 billion. Is rounding everything with, so you see a whole lot of zeros, which is, I guess, okay when you're talking about numbers that big, but I'd rather see what the company reported. Now there are two reports, the 10K, the annual report, and the 10Q. And I think I've already used this joke with you already, but I would ask the students, okay, in the face-to-face class, what's the annual report? 10K. Oh, good. Now, what's the quarterly report? 10Q. What was that? 10Q. And I'd say, you're welcome. I know, it's a sickness. And this was back in the 1990s. The Securities and Exchange Commission was a little miffed that some of this data would leak out to analysts and other insiders and professionals on Wall Street before it became public to the general public, before it became available to the general public. And so they said, we're going to implement Regulation FD, Fair Disclosure, which was made a whole lot easier by the use of now the newer technologies, including the internet. So the company can post this data to be, made public to the world at a certain time and announce that there's going to be an earnings call on March the 27th at 9:30 a.m. or whatever. And that's when you sat down and were able to download those and listen to the CEO and the CFO and the like. Now, you're going to hear, read, maybe be enticed to listen, read, watch the whisper numbers. You know, Home Depot is going to beat their whisper number by 2 cents, and here's the whisper number. Instead of $1.29, it's going to be $1.31 or whatever. Should you pay attention? And I think if you've been paying attention to us as prudent long-term investors, don't pay attention to the whisper numbers. Many investors opine that nowadays there is simply too much information. And a gentleman by the name of Nick Murray, now you're probably not going to read his books because they're more, unless you get into the industry, they're more dedicated to professionals, sales basically, the sales and marketing part of being in the profession. But he says it very succinctly. Wisdom sold separately. Yeah, there's just too much information. And as we said, and that's why, right, in our class, we focus on just a little bit of information from the value line and then tell you that you have the rest of your lifetime to expand outward. But the answer, by the way, to should you pay attention to the whisper numbers is no, don't play the whisper number game, but it's up to you. That's for short-term traders, speculators, and the like, betting, gambling, blah, blah, blah. Slide number 7, financial ratios. Now, we've already done a few, folks, and we're going to burn through the ones that we've already looked at. The financial ratios are relations between two financial quantities expressed as a quotient of one divided by the other. And of course, ratio analysis is the study of those relationships between financial statement accounts. So that's what we call this chapter, financial statements and ratio analysis. And what we want to make you understand is that there's no one ratio that can accurately sum up the overall general state of a company. Each ratio must be considered in the context of all the information that you've gathered. Plus, you must consider any ratio in the context of the industry the company exists within. And we're going to see some examples soon. So, the common stock ratios are the ones that are typically very easy to find on the internet, such as earnings per share, price to earnings ratio, dividends per share, dividend yield. A few of the others you have to, usually calculate the PEG ratio, although I've seen, I've seen the PEG ratio reported more and more. But, book value per share, that's usually in the case of Yahoo, you have to go to that key statistics tab, that statistics tab. But the price to book value, price to cash flow, price to sales, those are relatively easy to create. They're just division of two different, a numerator and a denominator. So let's take a look at the common stock ratios. Now, again, this is going to be, it's also called market ratios. This is going to be a lot of review. Earnings per share, right? That's review. It's the net income divided by a number of shares outstanding. And we did one in chapter 3, and you don't have to do it, you just look it up. Earnings per share is the amount of annual earnings available to common stockholders, as stated on a per share basis. We can think about each share that we own as a business entity in and of itself, earning X amount of dollars. So every little share is like a little factory or a business that's generating 50 cents or 60 cents a share. Earnings per share is the subject of much discussion and speculation, especially with regard to companies that are growing their earnings. Is their growth continuing? They don't look at the first derivative, they look at the second derivative. And if you don't know what I'm talking about, don't worry about it. But the first derivative is the velocity. How fast is it growing? The second derivative is the acceleration. That's how fast the growth of the velocity is going. It's the velocity of the velocity. In other words, they want to see that the company is growing their earnings very quickly. Earnings per share is subsequently used in combination with current market price to compute the most important stock market statistic, and that's the price to earnings ratio, the PE. So let's take a look at the PE on slide 10. This thing is argued over and yelled at and screamed at, and we've already seen one example where we saw the difference between Google and GM. Google had a very high PE. GM, this was 2005, and GM had a very low PE, but it turns out that Google was the better choice than GM because Google has since flourished and GM went through bankruptcy, and that was the old GM. But it's a very simple statistic, and you don't even have to do it. You just look it up. The most popular stock market statistic. Historically, PE ratios were in the 5 to 12 range. For mature companies, 14 to 20. For growing companies, but greater than 20 was unusual, but not anymore. The PE ratio also tells you how long it will take a company in years, assuming no changes in earnings, for the company to earn back its price. A PE 3 takes 3 years, a PE 20 takes 20 years. And so some people say, well, is that important? And I say, no, it's just something to think about. Just something to think about. If nothing else changes, and of course it's changing every day, it's going to take 20 years or 80 years if it's a PE of 80 or 3 years if it's a PE of 3 to earn back its price. So here are 6 different companies. Oops, these guys are not supposed to be there. My apologies. I got to go fix that. 6 different companies that you may have heard of. British Petroleum, Google, Biogen, it's a biotech company. Bank of America, Kraft Heinz, and Bristol Myers, the pharmaceutical company. And you say, well, there's PEs all over the map, right? British Petroleum is 7, Google's 24, Biogen almost 28, a little over 11 for Bank of America, 15 for Kraft Heinz, and 13 for Bristol Myers Squibb. Well, here's the problem. These companies are not competitors with one another. They're in totally different industries. What we need to do is we need to look at companies that are their competitors. And we find that in general, you're going to see similar PEs. And if not, we need to know why. We need to do more research. It's not a yes, no, continue or not continue with that company. It means we have to do more research. And so we see that the energy companies, by and large, have fairly low PEs, don't they? Yeah. Which another way of saying that is investors are not really that excited about energy companies. They're boring. Well, guess what? That's the kind of company I love, a boring company. That product is used every day and it's been around for decades and will continue to be around for decades. Oh, all the cars are going to be electric. That's fine. That's great. Oil is still the most important commodity around the world. Why? Because you're probably wearing oil now. It's in the fertilizer that grew your food. It's in the materials that all the plastics that you use. So it's a very important. If oil weren't available, we'd have to invent it. That's how important oil is. But then, as we get to the technology world, we see that Google and Apple, they're pretty high. Facebook is almost 34. But look at Amazon and look at NVIDIA. Oh my goodness, 60, 68. Something is telling us that we need to do more research about why Amazon and NVIDIA are commanding a much higher PE than Google, Apple, or Facebook. But it can be said that these companies, which are sometimes lumped into what's called the Magnificent Seven, aren't really competitors with one another. They're synergistic. Apple uses Google technology. Google needs Apple and all the other companies to use their platform. The same thing with Fleecebook, Meta. And then Amazon, people think of them as a grocery company, e-products, but they're more than that. They make a lot of money off Amazon Web Services. And then NVIDIA just makes the chips, so hooey. And of course, there's a ton of internet bits and television shows and the like spilled over these companies. What about the biotech companies like Biogen and Amgen? Well, they're not too high, but then AbbVie, what's going on here? 65. And Illumina, why does it say NA? Well, that usually means they're losing money. What's going on with Illumina? And just a few years ago, you would have seen that their PE was catastrophic, not catastrophic, big, high. Excuse me, astronomical in the 80s and 90s. So that means that's what the question mark there means. We got to figure out why AbbVie is commanding a much higher PE than Biogen or Amgen. The food companies, yeah, pretty boring. 15, Kellogg's 11, General Myers 15. Hormel, the people who make Spam. If I were Hormel, I would have an email campaign and call it, "This is Spam," and you want it in your email box. 23. So why is Hormel a little bit higher than the others? Obviously, investors are a little bit more excited about Hormel's prospects. And then the banks, boring. Don't you? I just love boring companies like banks. How do you know a bank is making money? Their doors are open. Now, in the 1990s and then the 2000s, banks got really exciting. And we know how that ended, right? The global financial crisis. So banks are hopefully continuing to be boring again. But now look at what happens when we get into the drug companies. Bristol Myers, actually very respectable, 17. Pfizer, 72. Eli Lilly, 134. And Merck, over 900. Yeah, we can't just look at these numbers and not dig deeper into why that's going on. What's going on? So you see, these become little red flags that tip us off to we have to do a whole lot more research and understand what's going on. Make sense? I hope so. How can we account for the wide price to earnings disparity between different industries and different companies within industries? Again, it's the expectation of future earnings and, in some cases, dividend growth by investors. It's all about the future. Are they right? Well, we'll know in 3 or 4 years, but then it's a little too late, isn't it? Now, if you're looking at this on your phone, you can't read this, but this is a wonderful quote from a man named Jack Dreyfus, who started Dreyfus Funds, which is now part of Bank of New York, Mellon. Take a nice little company, and this is back in the late 50s, early 60s, 1960s. Take a nice little company that has been making shoelaces for 40 years and sells at a respectable 6 times earnings ratio. Change the name from Shoelaces Incorporated, a boring company that I love, to Electronics and Silicon Firth Burners, which was a very exciting company at the time. In today's market, the words electronics and silicon are worth 15 times earnings. However, the real play comes from the word Firth Burners, which nobody understands. A word that no one understands entitles you to double your entire score. Therefore, we have 6 times earnings for the shoelace business, 15 earnings for electronics and silicon, or a total of 21 times earnings. Multiply this by 2 for Firth Burners, and we now have a score of 42 times earnings for the new company. So in other words, he's saying, the more people don't understand the company, the higher they're willing to pay for this price, the higher they're willing to pay a price for the company, even though they don't understand what the hell it does. Today, of course, you would replace Firth Burners with kleptocurrencies, electronics and silicon with NFTs, meme stocks, and the like. So the technology changes, but we humans don't. Yeah, there's an example. In fact, I talk about it. We talk about it when we talk about the biotechnology, nanotechnology example in the worksheet. About almost 20 years ago now, nanotechnology started making its way into the lexicon, making its way into the news and the like. And this one company by the name of Nanotech here in San Diego, all of a sudden their stock started to rise for no reason whatsoever, other than they attributed it to the fact that people say, oh, nanotechnology, I have to invest in it. I don't know what the hell it is, but I have to invest in it. And here's a company called Nanotech. That's what I got to do. Folks, you don't believe me, but that's the way some people make their decisions. Slide number 13. Now, we're going to burn through the rest of these common stock ratios because for the most part, well, most of them are review. Now, this one's not. The PEG ratio, it's called. It's really a simple way of seeing how close the PE ratio is to the expected growth rate. If you take a PE of 20 and the growth rate is 20, the PEG ratio will be 1. If the PE were 30 and the whoa, that's not what I want to do. And the growth rate were 15%, then it would be 2. 30 divided by 15. You got it? So a PEG ratio of 1 means that the PE ratio matches its growth rate, which was generally considered what we should do. Now, not anymore. With growth companies, sometimes the PEG ratio is 2, 3, 4, or higher. Equally, historically, a PEG ratio of 1 was desirable since it meant that the PE ratio equaled the growth rate. Anything above 1 was considered high, but now that's common because people are willing to pay up for growth. Dividends per share, this is review. A measure of how much dividends each share of stock will receive. You take the annual dividends divided by the number of shares outstanding, and we did this in chapter 3. It's not very difficult, and you just look it up. And as we discussed, dividends became taboo during the 1980s and 90s. Since the 2000 to 2002 bear market, many investors have changed their minds about dividends. Dividends can be discussed in polite company again. Dividends don't lie. And dear students, I tell you my biases up front, just so you know, because you're going to hear other people say, oh, I don't want dividends. Dividends don't lie. They wrote you a check. Well, they don't write a check anymore. It's all electronic. But still, you got the idea. All the other numbers, you don't know that they're right or not. And sometimes the people who create them don't know if they're right or not. They will write down next to one number, Paduma. Picked it directly out of midair. Or swag. Stupid, wild, yeah. Because, they're trying to do their best sometimes. And then sometimes, obviously, like Enron and WorldCom and Global Crossing, they were just totally lying. Dividend yield. Again, more review. How much dividends are as a percentage of the stock price? So it's a very simple calculation that you don't have to do because it's done for you. Dividends per share divided by the market price. This important statistic allows an investor to compare a company to other forms of investments that pay income such as savings accounts or bonds. Traditionally, 4, 5, 6% was considered good. Currently, around March of 2024, the S&P 500 is yielding 1.47%, while 10-year Treasury bonds are yielding approximately 4.18%. After years of very low returns, bonds are back, you hear bond investors say. Some savings accounts are paying as much as 5% since the Federal Reserve Bank drove up short-term interest rates in 2022 and 2023. But as some students, if you've been following along in the discussion forums, some students are finding that, oh yeah, we'll give you 5% if you give us if you deposit $20,000. But there are others that are saying, no, you only got to deposit $1,000, so you got to do your shopping around if you want those high yield savings accounts. And then the dividend payout ratio. Again, this is review. We take how much of the dividends, we take the dividends divided by the earnings per share. So it's showing you how much of the company's earnings are being paid back to the shareholders in the form of dividends. Now, as we said, most companies don't pay out all their earnings in dividends. But more mature companies often pay out almost all their earnings or a good amount of their earnings in the form of dividends. Growing companies retain their earnings, called retained earnings, to support the growth of the company. They can't afford to pay out the dividends. They got to plow it back into the company. And that's just expected. And as we said, many people got to the point where they thought, no, I don't want any dividends. You just keep plowing it back in or buy back your shares. Which is great in the short term, but I'm a more long term. I like companies that have been raising their dividends for decades. That's my kind of company. If you find any, send them my way. Slide number 17. We talked about book value per share, and that's the net worth of the company on a per share basis. So you don't have to do this calculation. You just look it up. As I remember in Yahoo, you look up it's statistics. It used to be key statistics. Now it's just statistics. You take the stockholders' equity divided by the number of shares outstanding. The book value per share tells an investor how much assets are behind each share of stock. In other words, if all the assets of the company were liquidated, how much would each shareholder receive? It is common for the actual market price of a share to be far above the book value per share, since the company is worth more intact than if it were dissolved. And this makes perfect sense, folks. And some companies, they don't have a whole lot of assets, but they're in business to make money, and that makes them worth a whole lot more than the assets, as we say, on the books. Today, it is common for the market price to be far above the book value. And we'll see some examples in Chapter 6, and you've probably already seen a few examples. Some companies have market prices way above the book value. And now we're going to take that same concept and look at the price to the book value and the cash flow to the book value and the like. So we take the price of the company and divide it by the book value per share. Now, what does that tell us? Okay, it's basically showing you how far apart they are. If we have the book value equal to the market value, it's going to be 1. But as we said, the market price is usually much higher, so we see that it's often going to be 4, 5, 6, or more. Given that the book value per share is often less than the market price, the price to book value per share tells an investor how far above the book value the market value is. If it's equal to 1, they're the same. 3, 4, 5, 6, or more is not uncommon. If the market price falls below the book value, we've already discussed this, haven't we? That's a dangerous sign. That means people are really, investors are really negative on that company. And if those assets on the books really are worth what the accountants say they're worth, and that's a big if, then the company is in real danger of being raided, of being attacked by corporate raiders, takeover artists, private equity firms. They go by various names. But they swoop in, buy 50% plus 1 of the shares, which means now they run the company. They can do whatever they want with it because they can vote 50% plus 1. And they vote to dissolve the company, pay off all the debts, and they hope that they're going to walk away with money in their pocket. It's capitalism, folks. It's not very nice if you've been working for this company for 22 years or whatever. And we said this already. That's why there's unemployment insurance, because we want that to happen. Yes, that capital is being wasted. That company needs to be plowed under. Now, that's a generalization. Maybe it's a total accident. Maybe it's not the truth. Maybe it is a very important company, and maybe there was hope or some promise of bringing the company back from the edge of the precipice. But hey, it's not a perfect system, is it? No. Anyway, slide number 19. Same idea, but in this case, we're going to take a look at the price and compare it to the cash flow. Remember, we did price to earnings, then price to book value, now price to cash flow. Current price divided by the current cash flow. And as we said, earnings and cash flow are not always the same. Cash flow often differs from earnings per share for several reasons, but the most common reason is depreciation, because depreciation is not an actual cash expenditures, as we saw. But there are many other reasons that cash flow and earnings differ. You might hear of good quality earnings versus poor quality or bad quality earnings. This is a very simple calculation that we can do. Take the market price and then divide it by the cash flow. And where do we find that? Yeah, I think it's in the key statistics in Yahoo. The value line is where I go. During the internet mania, many companies were reporting record earnings. At the same time, their cash flow was negative. Their statement of cash flows was showing that their checkbook was going down. Now, how could that be? Well, there's one perfect example, Lucent Technologies. Now, who are they? Well, before 1984, AT&T, the phone company was one big phone company. They had all the local monopolies. They had the long distance monopoly. There was a couple of players on the fringes, but no. They also owned their equipment manufacturer, Western Electric, and Bell Labs, which was the research and development. They're the people who brought you the transistor and in its first version, Unix, which became Linux, which is a very important system. Most people don't use it, but it's used by businesses and like is very important. Okay, so these are two really smart companies. They make the best telephone equipment in the world. And when AT&T broke up, they spun off eventually the Western Electric and Bell Labs into a company called Lucent. And at the end, throughout the 90s, this new telecommunications explosion, startup companies needed this equipment, but they didn't have any cash and no bank would lend them it. So they went to Lucent and said, hey, we want to buy $2 billion of your equipment. By the way, will you lend us the money to buy the stuff? Lucent said, sure. So they sold them $2 billion of equipment, but the $2 billion didn't show up in their checkbook. No, they were going to pay them $100 million a year for the next 20 years or whatever. And you know what? They never made a dime, those companies. They all went bankrupt within a few years. And they went to Lucent and said, here's your equipment back. Lucent almost went bankrupt in the dot-com implosion, in the internet implosion. They survived. So you see, they were making record earnings because they get to book that as earnings, but they didn't get the cash. And then lastly is same idea, price to sales. We're going to take the current price and divide it by the annual sales per share. Historically, a higher price to sales ratio suggested a higher sales growth, and a lower suggested a lower sales growth. It's a very simple calculation. Take the price of the stock and divide it by the annual sales per share, which is pretty readily available. During the internet mania, many analysts would use price to sales instead of price to earnings or price to cash flow, since many of the new high-flying technology companies never generated any earnings. So these, dear students, are the common stock ratios, and they're relatively easy to find or calculate. In our next presentation, we'll take a look at the ones that are not often, some of them are, but not often reported. But again, once we've learned how to pick and choose out of the financial statements, they're relatively easy to, actually very easy to do. So our assignment is going to be to take a company, and I give you 5 to choose, but you can do any big company. Don't do any small or mid-sized companies, okay? Do big companies. And do the same. Do these ratios. Now, the common stock ratios, as we said, are pretty easy to find, so we only want you to do 2 or 3 of those, right? But we want you to do at least 2 or 3 of each of the other categories that we'll discuss in our next presentation. So, oops, and there it is. We're going to start, my apologies. We're going to start on the next presentation with the profitability ratios. So see you in our next presentation, dear students. We are so proud of you.